Picture this. You're sitting at your laptop, scrolling through investment apps, and every single thing you click on feels like it's designed to make you fail. The interface is sleek, the buttons are friendly, but behind all of that is a system that's basically built to separate you from your money in the most efficient way possible. And here's what makes it worse. You know this, you can feel it, but you still don't know what to actually do about it. There's a specific approach to investing in 2026 that could save you from losing tens of thousands of dollars over the next decade. And it's the exact opposite of what most platforms are pushing you toward. My name is Megan. I'm an accountant, and here I share smart financial tips that anyone can implement today. If you're staring at investing apps feeling completely overwhelmed and you want to actually build wealth without getting destroyed by hidden fees and psychological traps, make sure to subscribe and hit that like button if this information helps you out. Now, before we dive into the actual strategy, let me paint you a picture of what we're actually dealing with in 2026. You open up one of these investing apps. Maybe it's Robinhood, maybe it's some new platform with an even sleeker interface. The first thing you see? Not information about index funds or compound interest. No. You see a list of individual stocks with little green and red numbers next to them, bouncing around like a scoreboard at a basketball game. GameStop up 47% this week. Some AI company you've never heard of down 23%. Tesla doing whatever Tesla does on a Tuesday. And here's the thing, this isn't an accident. Every single element of that interface has been A/B tested thousands of times to trigger one specific response in your brain. The same response you get when you're sitting at a slot machine. That little hit of dopamine when the numbers go up. That spike of anxiety when they go down. The platforms know exactly what they're doing, and they're counting on you not knowing what you're doing. But something remarkable happens when you understand the actual math behind investing. And I'm not talking about complicated formulas or technical analysis or whatever nonsense gets sold in those $997 courses. I'm talking about understanding one simple fact that changes everything. Here's what actually happens when you invest. Let's say you put $10,000 into the stock market today. If you leave it alone for 30 years and it grows at the historical average of about 10% per year, that $10,000 becomes $174,494. Not because you're smart, not because you picked the right stocks, just because you left it alone and let compound interest do its thing. But here's where it gets really interesting. If you also add just $500 per month to that investment over those same 30 years, you don't end up with a little more money. You end up with over $1.1 million. Now you might be thinking, that sounds great, but 30 years is a long time, and $500 a month sounds impossible if you're barely making rent. And you're right to think that. But here's the part that will blow your mind. The first 5 years of that journey matter more than almost everything else you'll do financially in your entire life. Not because of the money you'll make, but because of the habits you'll build and the psychological foundation you'll create. Let me show you exactly how this works and why starting in 2026 is actually different from starting in 2016 or 2006. In 2026, you're dealing with something previous generations of investors didn't have to face. You're dealing with unprecedented access to investing, which sounds like a good thing until you realize what it actually means. It means zero commission trading. It means fractional shares. It means you can buy and sell stocks from your phone while you're sitting on the toilet at 2 a.m. And every single one of those innovations makes it harder, not easier, to build actual wealth. I spent an embarrassing amount of time researching the psychology of investing apps, and what I found was honestly kind of disturbing. The average Robinhood user in 2024 had about a 2.3% annual return. You know what the S&P 500 did that same year? Over 20%. These people had access to the same market as everyone else, but they underperformed by almost 18 percentage points. Not because they were dumb, but because the system they were using was designed to make them trade. And trading is the enemy of wealth building. Here's what I would do if I started investing today in 2026, knowing everything I know now as an accountant who's seen thousands of people's financial situations. First, I wouldn't even look at individual stocks for at least 3 years. Not Tesla, not Apple, not whatever AI company just went public last week. 0 individual stocks. And before you close this video thinking I'm boring, stick with me here because this is where most people mess this up. The first $10,000 you invest should go into the most boring possible investment you can find, a total market index fund, something like VTI or VTSAX if you're using Vanguard, or the equivalent at whatever platform you're using. This is not exciting. This will not make you feel like a genius at parties. But here's the thing. This single decision will likely be worth more to you than every individual stock pick you'll ever make in your entire life. Let me put this in perspective with actual numbers. If you invest $10,000 in a total market index fund today and add $300 per month for the next 10 years, you'll have around $89,000, assuming average market returns. That's enough for a down payment on a house in most markets. That's enough to quit a job you hate and take 3 months to find something better. That's walking away money. But here's the kicker. If you spend those same 10 years trying to pick individual stocks, statistically speaking, you'll underperform that index by about 2 to 4% per year. Over 10 years, that's not just a few $1,000s. That's potentially $15,000 to $30,000 you're just handing over to the market gods for absolutely no reason except the illusion that you're smarter than professional fund managers who spend 80 hours a week on this and still can't beat the index. Now, here's where it gets interesting, and this is specific to 2026. You need to be aware of something called AI-driven trading tools and smart investing apps that are popping up everywhere right now. They promise to use artificial intelligence to pick better stocks, to time the market, to maximize your returns. And some of them sound incredibly convincing. Here's what you need to know. Even if AI gets really good at predicting short-term market movements, which is a big if, that doesn't help you. Because you're not competing against AI, you're competing against your own behavior. The real enemy of wealth building in 2026 isn't lack of information. It's psychological warfare that these platforms wage against your prefrontal cortex. Every notification, every red and green number, every "your friend just made $400 on Nvidia" push alert. It's all designed to trigger your loss aversion, your FOMO, your need for immediate gratification. And here's where most people completely miss the point. You can't win that war by being smarter or more disciplined. You win by not fighting it at all. So here's the second thing I would do. I would set up automatic investments and then make it genuinely difficult to access my investment account. Not impossible, but difficult enough that I can't make impulsive decisions at 2 a.m. when some stock is crashing or soaring. I'd delete the app from my phone. I'd use a platform that doesn't gamify investing. I'd set up a monthly automatic transfer of whatever amount I can actually afford, even if it's just $100. And then I'd essentially forget about it for at least 6 months. This sounds ridiculous to people who are new to investing. You're probably thinking, shouldn't I be monitoring my investments? Shouldn't I be staying informed? And here's the thing, no, not in the beginning. Because in the beginning, the only skill you're trying to develop is the ability to not panic when numbers go down and not get euphoric when numbers go up. That's it. That's the entire game for your first year of investing. But here's where most people mess this up, and I see it constantly. They do everything right for 3 or 4 months. They set up the automatic investments. They pick the boring index fund. They're building wealth. And then something happens. The market drops 8% in a week. Or maybe it surges 12%. Either way, they log in. They see their balance is different from what they expected, and their brain goes into fight or flight mode. When you have $1,000 invested and the market drops 8%, you lose $80. That's a nice dinner. That stings a little, but you can handle it. But when you have $10,000 invested and the market drops 8%, you lose $800. That's rent for some people. That's a plane ticket. That's real money. And your brain doesn't care that it's temporary. Your brain doesn't care about long-term averages. Your brain sees a number going down and screams at you to do something. Here's what actually happens in that moment. You have two choices. You can sell and lock in that loss, which is almost always the wrong move, or you can do nothing, which feels psychologically impossible, but is almost always the right move. And this is where the identity shift happens. You're not just someone who has money invested. You're becoming the type of person who can watch $800 disappear on paper and go about their day. That's not natural. That's not easy. But that's the skill that separates people who build wealth from people who just move money around for decades and end up with nothing. Now, here's the part that will probably surprise you. After you have your foundation built, after you've proven to yourself that you can invest consistently for at least a year without panicking or getting too excited, then you can start getting a little more interesting with maybe 5 to 10% of your portfolio. Notice I said 5 to 10%, not 50%. This is where you can buy individual stocks if you really want to. This is where you can invest in something you believe in. But here's the rule. This money is play money. This is the money you're willing to lose. Because even if you're right about a company, even if you do your research, individual stock picking is still closer to gambling than investing. Let me give you a concrete example. Let's say you have $15,000 invested. You've been doing this for 18 months. Your foundation is $13,500 in a total market index fund, growing slowly and boring you to death. You take $1,500, which is 10%, and you buy stock in a company you actually understand and believe in. Maybe it's a company you work for. Maybe it's a company whose products you use every day. You're not trying to get rich off this. You're scratching the itch to be involved in individual investing, but you're doing it in a way that can't destroy your financial future. Here's what most people don't realize about investing in 2026. You have access to tools and resources that would have cost thousands of dollars 20 years ago. You can invest in virtually anything with no commissions. You can buy fractional shares of companies that trade for $500 per share. You can access research and data that was once limited to professional investors. All of this is amazing, and all of this is also a trap, because it makes you feel like you should be doing something with all this power and access. But here's the thing, the best investors in the world, the ones managing billions of dollars, they're not constantly trading. Warren Buffett, who's been doing this for like 70 years, his biggest advice is to buy index funds and hold them forever. Not because he lacks access to better opportunities, but because he understands something fundamental about markets and human psychology. The people who win are the ones who can ignore the noise. And in 2026, the noise is louder than it's ever been. You've got financial influencers on TikTok telling you about the next 10x opportunity. You've got AI tools promising to make you rich. You've got Reddit communities turning random stocks into memes. You've got apps that send you notifications every time your portfolio moves by $5. All of this creates the illusion that investing is about being active, about being smart, about being involved. Here's the actual truth that could save you tens of thousands of dollars over the next decade. Investing is about being patient, being boring, and being consistent. That's it. Every single study on this topic, every analysis of actual investor returns over decades comes to the same conclusion. The people who build wealth are the ones who invest consistently in diversified funds and then do basically nothing for decades. Now, you might be thinking, this all sounds great in theory, but what about inflation? What about market crashes? What about the fact that 2026 is politically weird and economically uncertain? And these are good questions, but here's what you need to understand. Every single year feels uncertain when you're living through it. People in 2016 thought the market was too high. People in 2020 thought we were headed for a depression. People have been predicting crashes and catastrophes for decades, and yet the market keeps trending upward over time. Does this mean you should ignore risk? No. It means you should understand that the biggest risk isn't picking the wrong stock or investing at the wrong time. The biggest risk is not investing at all. The biggest risk is waiting for the perfect moment that never comes. The biggest risk is spending years moving money between savings accounts and checking accounts while inflation slowly erodes your purchasing power, and you tell yourself you're being careful. Here's what changes when you start investing, and this is something nobody really talks about. It changes how you think about money everywhere else in your life. When you have $10,000 invested and growing, you start thinking differently about spending $100. Not because you're cheap, but because you start seeing opportunity cost. That $100 could be worth $1,700 in 30 years. Is whatever you're about to buy worth $1,700 of future wealth? Sometimes yes, sometimes no, but you're asking a different question than before. This is what I mean by the identity shift. You're not just someone with investments. You've become the type of person who thinks about future value, who understands delayed gratification. Who can resist the constant pressure to spend money on things that don't matter, to prove something to people who don't care? And that identity is worth more than any investment return you'll ever get. Start building that foundation today. Not tomorrow, not when you have more money or when the market is less scary or when you feel more ready. Today, because your future self is counting on the decision you make right now. And 10 years from now, you'll either be someone who wishes they'd started investing in 2026 or someone who's grateful they did. The first $1,000 is the hardest. The first year is the scariest. But once you break through that barrier, compound interest and compound psychology work together to make wealth building feel almost automatic. Trust me, your future self will thank you for it.